FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 9/4/19. We are back. Survived Hurricane Dorian. Did a lot better than people out in the islands for sure. Hey, sometimes you do get lucky in this world, and fortunately, it just slipped right up the coast of Florida. Little storm surge here and there, but generally not much. So could have been a major disaster. Imagine a Category 5 hurricane hitting the Florida coast. Hey, it could very well happen. It just didn't happen this time. But we might very well be in store for a Category 5 hurricane hitting the global financial system. How close are we to that occurrence? Well, Danielle Park is with us now. Danielle, how do we evacuate when we're being hit with a Category 5 economic collapse?
That's a really good question, and one that I get often because people are writing me a lot through the blog lately saying, hey, whether they're in Australia or whether they're in Europe or whether they're in North America, sort of concerned about how, negative rates are spreading throughout the world, and it's getting harder and harder to find anywhere that's liquid and quote unquote safe, and then concerns about the implications for the banking system and what that might mean in terms of, whether deposits are going to be in risk going forward. And a lot of people, of course, interested in precious metals again, as the price has rose in the last few months. So the questions are always about, what are the options? What are the risks and pluses of allocating certain amounts in different places? And then, always from a top down. I think that's the most important thing that people really miss, Kerry. I've seen it so often in the last 25 years where they approach, they get an idea like, even, for example, precious metals. Great. The question is, how much of your allocation should you put in any one area? And that discipline of deciding how, what, where, and why is more work than many people are prepared to do or think to do before they just start slapping money into different things. And I think that that's the difficulty, because at the end of the day, what they really need is to protect their liquidity in this environment. So that means that you don't want to have your money in things that have to be sold to give you back your cash if you're going to need cash. If you're properly allocated in this environment, you should have either not a lot of long exposure to things that are at record valuations. That would be corporate debt, stocks, some derivatives, and all sorts of options and things that people have been using the last few years to participate on the upside. You need to have some kind of either a hedge or have left those positions or minimized them in order to build up cash so that you won't be in forced selling when the things unwind. So, for example, just a really obvious example, but one that I've seen many times, is during bull markets, it becomes common sort of wisdom to put all cash into things like the S&P 500 as a surrogate for liquidity. So the people will say, well, you're making a dividend, and you'll hear it right now. You make a dividend yield that's higher than the 10-year Treasury. Why wouldn't you put your cash into something like the S&P 500? Diversified basket, what's the problem? Well, the problem is that it's not the same thing as cash. It doesn't hold its place like a bookmark when things start falling. And if you need, for example, cash to pay your household bills or cash to pay operations in a business, and I've seen this many times, people have excess capital in their operating sort of accounts for their business. And instead of keeping it in cash and liquid or even treasuries, something that can be quickly converted into cash, they do things like throw it into, indexes, which is a bad plan, because then you're not going to be able to ride out when your revenue starts to fall. And then you turn to your cash surrogates and start having to sell assets as they're dropping. That's the opposite of what you want to do. So you want to design it so you've got good buffers in your operating accounts, whether it's households or businesses, that you don't don't have a lot of long exposure, if you do, that you've got a hedge. If you're using things like precious metals and bullion, for example, great. What portion of your money have you got in bullion? Realizing that your bet on that is a bet that everything else you own is going to be having a hard time. And make those decisions as to what's a rational percentage. I think that's the work that few people do well in advance of these downturns, and that's why most don't fare well during them.
Yeah, and how much risk really can one withstand? We're all risk managers, whether we're on default, right, or whether we're actually actively doing it. So we kind of all need to act as risk managers, right?
Absolutely. And life is full of risk. I say this all the time, but it is full of risk of every kind every day. And, to think that, here's the other thing. Recessions are a normal part of the situation. They are part of every cycle. They're not, freaks. They're just predictable. They happen. The timing is never quite predictable, but they're a normal part of it. So a good plan plans for recessions, doesn't plan or hope that they don't happen. Hoping that they don't happen is a terrible approach. Planning for them means that you're taking defensive moves in advance, that you're preparing yourself to take advantage of things when they go on sale, that you've got enough liquidity that you're not forced to sell something, so that when things start dropping, you can say, hey, where's the opportunity here, instead of, oh my God, my hair's on fire, which is what most people do.
Yeah, so we're looking at the markets now. The market's gone down a bit. It's been very volatile, but it hasn't collapsed yet, has it?
No, well, depending on what market you're looking at, of course. The U.S. markets have held up the best of any in the world. The Indian market was holding up very well, but it too has been selling off in the past year. The thing that's been actually the best performing asset has been long government bonds, long treasuries, which have increased significantly more than the stock market. And that's been the case, frankly, for the last 200 years. If you look at the outperformance of treasuries, long treasuries over time, they always have an edge on stocks, but that, time frame is not relevant to the average person, really. But what's important is that existing bonds have been seeing such inflows. This is why we're getting negative yield, is that people are bidding them up so high that they are bidding them far above what they're going to mature at, even considering the income you receive. So it's possible, for example, that the existing bonds in North America, especially the government bonds, will appreciate further. Alan Greenspan was saying on CNBC today that he thinks it's only a matter of time before negative rates spread to the U.S. And we've been saying that for some time, because there's these forces that are at play. And, everyone's focused on the trade wars for sure, but the trade wars are a symptom of what's actually going on. They're not the catalyst for the problems we're now facing. The actual catalysts are the longer term trends, which has been the debt abuse, the financial gimmicks that have inflated asset prices, that have made the cost of living abhorrent for the average person because their shelter and things like education have gone up so much that people can barely afford to feed themselves. This is the world that has created all of the social unrest. And then you get, the dictatorships, like the mess in Hong Kong right now. China always was a communist country. They never were, free market principles and in favor of democracy and all that. They never pretended to be. But during the expansion part of the cycle, when credit was flowing and things looked like they were all going up, people wanted to believe that they were dealing with a kinder, gentler force there. But in reality now, of course, the truth is that they were always wanting to advance further control over places like Hong Kong. I mean, they've been waiting a long time since they took it back. And this was sort of inevitable. But what you've got is, everyone now looking at them and saying, oh, I didn't realize that you were still that political force that was trying to quell democracy and free rights and all that sort of thing. And also, they always were a country that was trying to take it technological secrets and advantage when they were doing deals for manufacturing. But as I've pointed out before, that's a playbook they've taken from many other countries. That's not just something they invented. That's something that's been common in developing economies over the many centuries. So, it's almost like these things have always been sitting there, Carrie. It's just that the veneer of civility falls off when you get credit crunch, when you get, asset markets volatile, when you get people looking to point fingers and say, I thought we had some magical solution, but it turns out it's just the same old, same old.
Yeah, well, the more things change, the more they stay the same. But what choice was there on Hong Kong? The Brits had a 99-year lease on it, and once that lease was up, they had to give it back. And once Chinese have sovereignty over it, they can pretty much do what they want. But it looks to me like the Chinese are caught behind a rock and a hard place.
I think my thought is, and I may have mentioned this before in talking with you, but I think that the Chinese would very much like to smoke out the current presidency, the current powers that be in the United States. And to do that, they may indeed try and, just wait this out until your next election cycle. And I wouldn't be surprised at all if they used, the Cambridge Analytica approach to, muddying waters against the Trump administration to try and turn voters in this environment. And hopefully, I think from their perspective, have a regime change and then possibly have different people to negotiate with. I mean, this close to the election cycle, and the same's going, in Canada. We're coming up to a fall election. We've had ongoing troubles with the Chinese regime and policies currently in place. And they may indeed think, let's play the slow game here and just wait for these transitions to happen to see who we actually have to negotiate with. So I think it's, anything can happen in the next 18 months. And meanwhile, the global economy is slowing appreciably. Today the Bank of Canada surprised with a sort of a reiteration of its stance that we're not cutting rates yet. But I think that it's a matter of time, because the reality is that although the second quarter was slightly stronger than they'd expected, these are transitory factors. And when you look at the demand cycle, it's very much turned down. The credit cycle has very much turned down. Housing cycle, has turned down. New starts, the capital investment by businesses, definitely. CEOs are more as pessimistic as they were in going into the 2008 recession today. So there's not a lot of capital investment planned. All these things matter in the end. And I think that will continue to be sort of the moving ground under record asset prices and these very precarious, house of stilts that's been built over the last decade of just adding more debt and pushing prices up further and not doing anything. The article I was writing about today about EVs, and you and I have talked about this a lot, is how it's great technology. And now the Porsche CEO is out today saying, hey, it's the future. We agree. The turning point is here. Electric vehicles are the bomb. But at the same time, let's not kid ourselves. This is a massive investment cycle that needs to happen here. They're way behind the eight ball. People have been mocking Tesla and the financial strife it's had to go through to make the products it's made to date. It's a very cash-intensive business. But these other automakers now have to remake themselves, because they left it so long. They've grown sort of fat and lazy on the easy profits of SUVs and pickup trucks, which have been their fat margin business for the last number of years. And yes, they will transition them to electric vehicles. They're, Rivian trucks and all this, they're doing it. But that's going to be hard on profit margins. Let's not kid ourselves. There's a lot of investment up front. And this is, dealing with, quote, activist investors and others who are used to the last decade of, quote, easy money, where they could get their principal back quickly with dividends and buybacks and things to boost share prices, which were all done at the expense, frankly, of longer term vision and investment. And now we're at a transition where they're saying, okay, we're really going to double down on this EV thing now. We really need to catch up. But it's going to take a lot of money to do it. And they very well may need to, forego the buybacks, even if they, I think they may get legislated to not do buybacks in the next election cycle as well. But even if they don't, I think it's going to get harder and harder to waste money on those things when they need so much in terms of transformation capital.
Yeah, well, we'll see what happens there. I'm not convinced that it doesn't end in a big bang, and we're just nobody's going to get a chance to act rationally here. In emergencies, when they happen, they aren't thinking rationally. If you watch those movies like The Big Short, like Margin Call, it's kind of every man and woman for themselves. And really, it's hard to think that somehow this is going to lead, at least initially, to something better for everybody. But fact is that we've been kind of doing this stuff for thousands of years now, and all to the same end.
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Yeah, so I guess the hardest part to imagine is that the human memory is so short, that it only takes a decade, albeit the longest expansion cycle in history. And yes, that's been longer than most, but it's only taken a decade. And we had a very vivid example of what the downside looks like when you've got inflated assets and too much leverage and complacent people throwing money around like it's, jelly beans. So we already know, and then there was that whole stream of films and documentaries made in the last few years to remind us of all the conditions that caused that last collapse. And indeed, we've doubled down on those same things and have them all even more so this time. So it's surprising to me that people could be as complacent as they are in thinking or coming in late, levering up, tossing their liquid operating capital into things like equities as a place to park it. I mean, is mind-boggling, but this is the common pattern. It is what people do. And so they are not then prepared, as you say. It doesn't need to be catastrophic that these down cycles occur, but because people are so ill prepared and exposed and magnified to the risk, that's why it ends up being such a heavy whack.
Yeah, no doubt. So the downside of the Chinese waiting for regime change in the United States is that if regime change doesn't come, they're going to be doubly screwed. And right now, they have the opportunity perhaps to make the best deal that they're going to. My own personal opinion is that Trump is going to be reelected, mainly because there is no competition to speak of. The field is pretty pathetic, and none of them are really in a position to take Trump on. But elections, the electorate's fickle. Who knows? But for Trump's core constituency and the people who got him elected, regardless of the negative PR, etc., the odds are, plus he's an incumbent. There's only been 2 incumbents post-World War II who have been defeated, Jimmy Carter and
Bush 1.
Bush 41. Those are the only 2 that have been defeated. Every other incumbent has, regardless their popularity, have gone on to get reelected. So it's bad to gamble on the outcome of a U.S. election, because even if you...
But you see, here's the thing. What I guess I'm saying is that these powers are much larger than who happens to be in power at this moment. So the downturn that happened in the demand cycle, in the credit market, in liquidity vanishing and everyone starting to feel the strife and strain of a rising U.S. dollar, those are for factors that are far beyond who's in power at a given time. And so at this point, there's nothing that any of those governments can do to turn this around. I think the full weight and force of a down cycle is required to clean out, to reestablish value, to take out the deadwood, so to speak, and that will create the great opportunity and the sort of the recalibration that needs to happen. And whoever happens to come into power, if that happens over the next 18 months, it may be in process already if it continues. Whoever happens to be in power in January of 21 is going to, deal with the fallout, but probably be in through a great deal of the downside already. In other words, it's like when President Obama came in, at the depths of the recession, and things turned up from there. It wasn't because President Obama came in; it was because we'd been through a profound down cycle, and it cleaned out a lot of the, waste and problems that had been created by the upcycle. So, let's not confuse a change of the guard as a solution or the end of the problem.
Here's the thing: if Trump hadn't been elected president, and I don't think any other candidate, we wouldn't be in this trade war right now with China. This is just never going to happen.
Okay, that's fair. But let me just, but what I'm saying is, I agree with you there. But what I'm saying is that it's like whenever money's flowing and you can keep adding to the line of credit and everybody gets what they want, everybody's happy. As soon as there starts to be a crimp in the line and all of a sudden some people aren't getting what they wanted, whether it's corporate welfare or more social benefits, whatever side of the spectrum you're on, as soon as there's a crimp in that flow and people start being faced with strain and cuts and, less easy money, you're going to have broad-based unhappiness and it's going to continue to perpetrate itself. So I think that's what I'm saying is that he may well, as I've said before, deflect attention to or blame China, blame the trade wars. And it's politically probably pretty smart of him to say, look, it's not me. I had to take a stand. These guys haven't been fair. So I've been doing this in our best interest. And that way deflect the fact that really the systemic changes that are needed are not as simple as coming to a trade deal with China.
Yeah, I hope. Look. It's the tail wagging the dog. There's a lot of reasons why China got in the position where they are. And, but, this whole thing wouldn't have come to a head with anyone else. So what my point is that it does matter who is president to some extent, whether there's a deep state that actually run things or not, the president can wreak a lot of havoc. And my point is it's always a bad idea to bet on the outcome of an election. Two things I learned in life: don't bet on the outcome of an election, and don't bet on the outcome of a lawsuit, especially if you're involved in it, because no one can tell how they're going to turn out and how important they might be. Well, a lawsuit could break you as an individual. It could break your company. It could break an industry. I've seen it happen. And a presidential election, we could debate the importance of the president in any country and that he really serves the interests of the entrenched. And, it's kind of the king is dead, long live the king. But there are consequences that you can't avoid. So, Canada, Vancouver housing prices are sinking. Vancouver condo prices are sinking. Banks, Eisman is shorting Canadian banks. What's going on with the Canadian economy here? Because to some extent, it is an important thing for the U.S., but, it's an important economy. And it's certainly a big indicator for the resource sector, because it's so resource dependent. We have seen gold go up. Silver just broke $19 the ounce. Platinum is heading towards 1,000. Platinum hadn't, not that you have any platinum up in Canada. The point is resource sector on the upswing, copper down, other base metals are down. Where is Canada? How's Canada going to make out in all this?
Yeah, so I would suggest that those industrial metals continue to be under pressure, that being things like copper or even the price of oil, although today there's a big bounce on this tanker development in the Middle East. But basically, oil continues to be in a downtrend and has been since it last peaked in sort of late 2018. Early 2018. So I would suggest to you things that are used in the creation manufacturing. I mean, look at all the PMI manufacturing. They're all breaking below 50, including the US this week. So there's this downturn in manufacturing globally. So things that are used in that capacity, and yeah, to a small extent, silver is used in that. But I would suggest to you that the support for precious metals has not been to do with that. It's been to do with this idea of where do we allocate in this environment that's likely to hold its ground or not fall off the cliff with these other asset classes, which have all been, deteriorating fundamentally underneath. The breadth has been bad. They've been vacillating for 18 months. The S&P's gone nowhere. Just massive trading range for the Canadian market. And we've spent a few years here now just back and forth going nowhere. So I think that that's the play on the precious metals side that you've seen. But that's not really the most important thing to Canada. Our economy is, of course, traditionally, and certainly in the '08 peak cycle, was all about the rocks and trees that were being sold, just like Australia, again, for manufacturing goods, largely in places like Asia that were then sold back to the West. So it was sort of transitory demand in the sense that it wasn't being consumed by Asia so much as the final goods were being consumed in the West. And so what that did was, we went into that last downturn with not as much leverage as you in America in our banking system. Our housing market had appreciated some, but nothing like the cycle that you saw into 2006. And our household debt levels were much more modest relative to you. Flip forward 10 years, and our household debt levels went far above yours. Our housing market inflated equally, if not more, in many of the key areas, Vancouver being one. And again, a lot of this about the money flow leaving Asia, money flow that was built up in the credit bubble that we sent to them in buying cheap goods, and they stockpiled all the cash and then started looking for places to put it, just like the Japanese did in the late 89 cycle when they were looking around the world for places to put money. So really, that's been the driving force in Canada the last decade, has not so much been resources when they sort of peaked and fell over, but it has been this push in the housing market, low rates, all the services to do with housing and accounting and legal services, everything to do with that has really been the main driver, construction of our economy. And so now, we tittering at the edges of it, we saw, a lot of social unrest around unaffordable housing, which made them bring in new policies, the governments, to try and tweak it and make it a little bit less speculative so that the average person could afford a place to live. That's all been at the margin, what started to turn the housing market. But then it was, as we've said before, China cracking down because they had liquidity issues at home and didn't want all the money leaving, and started, making it more difficult for funds to flow. Now, a good question is, with the Hong Kong, mess that's going on and the violence escalating, to what extent are people now moving funds wherever possible out of Hong Kong, and might they try and move back to places like Vancouver, as an example? I think that's all logical. They probably would. Would you rather have money in Hong Kong right now, or somewhere like potentially a Canadian bank or Canadian land bank? So that could be a source of flow again coming in. But ultimately, I think it's about this needing liquidity stuff. Everybody got up to their eyeballs in piling money into assets. And when they need to pay their bills, they need cash. When they need to, leave a country, they want to take money with them. And that's got harder to do with all the rules and regulations that have come in the past few years. So I think ultimately, Toronto is so far holding up reasonably well. Yes, Vancouver has shown some significant downside action, but if you look at the historical property values there, they're still remarkably above where they were in 2016, 17. So, there's been a negative downturn in the last year. There's making progress in this mean reversion that has to happen, but prices still remain extremely elevated. And the Bank of Canada so far, as it said in its announcement today, thinks it's holding pat, but ultimately they're only at 1.75. They're even lower than your central bank. So there's not a lot they can actually do. It's more like, hold the big promise that they can do something. And I think once they start, it'll be revealed very quickly. They've got very little to work with in terms of stimulus.
Agreed. And interesting point you make. So a lot of flight capital going to be coming out of Hong Kong, and I would venture to say mainland China. Because look, when something like Hong Kong happens, heads roll. Somebody, one one thing about the totalitarians is the ultimate in accountability. So whoever is responsible for this Hong Kong policy or perceived to be, or who can be blamed for it, because all be about saving face. So you can see a large swath of China's leadership just being cut out and literally taken into a field and shot after the 15-minute trial, which is a joke. So definitely money's flowing into the U.S. as well, into all 57 states here, into New York, into Florida, California, Massachusetts, because the Chinese do understand American real estate, and they know how easy it is to buy, especially when you have cash. And we've had a little bit of a slowdown here in the real estate sector, not a big one. I mean, in Florida, it's still going. They said 500,000 people moved into the state last year, but certainly flight capital, and I believe there's flight capital coming in from Europe as well. We didn't even talk about Brexit, but unstable European banks, they make the Canadian banks and the U.S. banks look like, well, you know what I say, the U.S. dollar is the Taj Mahal of Baltimore. So, that's kind of what we're looking at. The U.S. banks are the Rock of Gibraltar in, California. So, that's the way you have to look at it. Like, your choices aren't good, but it's between bad and really bad. And so that's part of what's kept the U.S. up. I think this trend's been really underway for a decade. I think it's accelerated over the past 2 years. It's hard to get the numbers on it because you don't know, because like we've talked about before, there's no transparency. So you don't know where the money's moving from necessarily, but you can kind of glean it from certain numbers. Anyway, we have gone way, way over, but it was great to talk to you again. And I told you my next car is going to be a Tesla for sure. I just want the full autonomous driving option so that I can, I don't know if you've seen the YouTubes, Danielle, but there's a guy passed out in the front seat of the Tesla, and the Tesla is on autopilot and it's driving 70 miles an hour. And then the guy wakes up and takes control of the car again. There was another one where guy is passed out drunk and the police see he's going 70 plus miles an hour, and they're going for 10 miles. And finally they figure out the best way to do it is to cut him off and then slam on the brakes, because then the Tesla will stop. And then he was arrested. But, that guy those two guys would have been dead or seriously injured, but for the autonomous features of the Tesla. So they really should be thanking Elon Musk and heaping praise upon him for their lives. Forget about the fact that they got apprehended afterwards.
Yeah, you know what? I haven't gone to a gas station since last March, and I got to tell you, I don't really miss it. I don't miss it, and I've spent zero on travel, since March. So I got it and my insurance went down by 25%. Yeah. So I'm just saying, it's in financially the best interest of people to be able to buy electric cars if they're looking to buy a car. Yeah, yes, take buses and walk and bike and do all that. But if you're looking for your own car, EVs are going to be the bomb in terms of saving money. Yeah, well, they certainly have turned the corner. It is now cheaper, total cost of ownership, to own a Tesla Model 3 than an Audi A4, way, way cheaper. And it's as cheap as owning a Toyota Corolla, because of when you take into account resale value at the end, when you want to get rid of it, and maintenance is way, way cheaper in these electric cars because they got hardly any moving parts. And the batteries are good for 150,000 miles, all these factors. And they're only going to get better. But Tesla just has to pray that the flow of easy money, of free money, keeps flowing, and they'll be the winners. But if for some reason it gets cut off, they're going to be in a world of trouble, because their underlying operations at the present time, maybe they're profitable, maybe they're not. We don't really know. We do know that their cash flow is negative because they're having to build the infrastructure, all these superchargers, which are great and is a moat, effectively, a barrier to entry to all the other car companies, because where is GM going to build all their
superchargers. And hey, maybe it's a business we need to get into here, Danielle, is the supercharger business. I think I could set one up right here in front of my house. I don't know if the neighbors would like it, but all they do is come over here, plug the thing in, and hang out.
They're pretty innocuous, I tell you. They don't make noise. They don't smell. They're silent. They're not a hard gig, the charging stations, for sure. They're pretty cost effective. They're a lot cheaper than putting in gas stations.
Oh, yeah. And I'll give them free coffee, too. They fill up with me. I'll give them free coffee. I'll even give them bagels. I'll charge them cost for the bagels. I was at a shopping center, and there was row after row after row of the superchargers. Of course, there was no cars there. And I love the fact that you program in your route. And if you're going to need to be charged, it tells you which supercharger to go to, how long the wait is, if there's other cars there. It's totally brilliant. He's built something that really is the envy of the world. Now they're shipping these things. They can't make them fast enough. It's what it comes down to. So it's also confidence. If the confidence in Tesla's viability is there, they'll get the money. And if it's not, they won't. Hey, look, I told you before, and I've always been amazed that he's the first company in the U.S. post-World War II to actually start a car company from the ground up and become a major producer, hundreds of thousands of vehicles. Never been done. I mean, that is a Herculean task. And unless you've really watched the car industry, you can't appreciate how monumental that task is. So
and let's not forget that the conventional car makers were bailed out 10 years ago. And who would you rather be buying if you're an investor? Do you think that people are going to want to invest if Tesla gets in trouble? Do you think there's going to be capital swooping in to rescue that company over Ford, perhaps? Ford, I'm just saying, when you've got that kind of product, I know they have financial challenges. All the car makers do, but at least they've got the leading technology. So I think they're going to have no shortage of people wanting to buy them if they start to have more financial trouble.
Oh, yeah, that's for sure. But that's not in Musk's radar at all. He's going to make the thing work. And I think with the reduction of battery costs and other things, economies of scale, there's not enough economies of scales in the Tesla. Anyway, we could talk about this all day, but make sure you check out Danielle's site, jugglingdynamite.com. Email address for questions, comments. What do you think about the Tesla? I got a lot of negative blowback, but until you really understand.
From people who don't own them, they're all full of negative.
But, like people who've studied it, I was negative until it reached critical mass of the Model 3. That car company was not going to make it on the Model S or the Model X. And there were a lot of problems with it. But look, the other thing, Danielle, like, I watch this car channel, Scotty Kilmer. He is the best. He's like a redneck shade tree mechanic from Houston, and although he's originally from New Hampshire, and he knows everything about cars, everything. And the one thing I've learned is that all the luxury car brands, they're made to last a 3-year, 4-year period, and then they fall apart. Now, I never keep cars that long, so I haven't experienced it, but I won't go into the names. You know them. They're household words. All of them have been going downhill. The only decent cars left basically are Toyotas and Hondas. Those are the best by far. All the other ones just fall apart. Ford pickup truck, several of the Ford vehicles, they're up there, but the rest of them are garbage. Subarus aren't too bad. So we're looking at every other car company, regardless what they charge, and forget about exotics. They're all garbage. They fall apart and become money pits when they get old. And you know what? The Tesla is not going to be a money pit. Yes, you got to change a battery. It's going to cost you a lot. Different things it will cost. But anyway, good luck with the Tesla. Glad you're enjoying it. I know there's one in my future. If you think there's one in yours, email me, even if you think there isn't. KL@KerryLutz.com. Twitter feed @KerryLutz. Facebook page, Financial Survival Network. Danielle, we'll talk to you in a couple of weeks.
Thanks, Gary.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.